Brad Williams, Frugal Finance, Accounting Income-Based Decision Rules. Many of the oldest and most established project decision rules have been drawn from the accounting statements and in particular from accounting measures of income. A few of these rules are based on income to equity investors, e.g. net income, and some others are based on operating income. Return on capital on a project measures the return earned by the company based on its total capital contributions in the project. Consequently, it is a return to all claim holders in the company on the collective contributions in a project. Defined generally, return on capital equals earnings before interest and taxes divided by average book value of capital invested in the project. Return on capital after tax, earnings before interest and taxes times 1 minus the tax rate divided by average book value of capital invested in project. To illustrate, consider a 1-year project with an initial capital contribution of $1 million and earnings before interest and taxes of $300,000. Imagine that the project has a salvage value at the end of the year of $800,000 and that the tax rate is 25%. In terms of a timeline, the project has the following inputs. Earnings before interest and taxes, $300,000. Book value equals $1 million. Salvage value, $800,000. Average book value of capital, $1 million plus $800,000 divided by 2 equals $900,000. The pre-tax and after-tax returns on capital can be calculated as follows. Return on capital pre-tax, $300,000 divided by $900,000, 33.33%. Return on capital after tax, $300,000 times 1 minus 0.25 divided by 900,000 equals 25%. Here, simple calculations. Even though this calculation is rather straightforward for a 1-year project, it becomes more complicated for multi-year projects, where both the operating income and the book value of the project change over time. In this case, the return on capital can either be calculated each year and then averaged over time, or the average operating income over the life of the project can be used in conjunction with the average capital contribution during the period to determine the average return on capital. The after-tax return on capital on a project has to be compared to a hurdle rate that is defined consistently. Return on capital is calculated using the earnings before debt payments and the total capital invested in a project. Thus, it can be viewed as return to the company rather than just to equity investors. Therefore, the cost of capital should be used as the hurdle rate. If the after-tax return on capital is greater than the cost of capital, do the project. If the after-tax return on capital is less than the cost of capital, don't do the project. For example, if the company considering this project had a cost of capital of 10%, it would view the investment in the project as a good one. Establishing and using return on capital in decision making, Granite Quick Charge, and capital construction door company projects. In example 3.1 and 3.2, we computed the operating income from 2 startup projects. Capital Construction and Retail Door Company and Granite Construction with a startup construction quick charge battery company. We will calculate the return on capital on each of these projects using our earlier estimates of operating income. Worksheet 3.8 summarizes the estimate of operating income and the book value of capital at Capital Construction. So here we have, for Capital Construction, we have after-tax operating income, 120, 183, 216, 252 for an average of 193. Book value capital at the beginning, 1.15. Book value capital ending, 930. Average book value of capital, 1040. Return on capital, 11.54. We're just going to go through this, and it looks like the return on capital, 28.91. The book value of capital each year includes the capital contribution in fixed assets and the non-cash working capital. If we average the year-specific returns on capital, the average returns on capital is 44.82. Now, I don't know. That number, 108, 28, 55. That number could have been tied to a different project, but just shrug it off. But this number is pushed up by the extremely high return in year 4. A better estimate of the return on capital is computed by dividing the average after-tax operating income 193 over the 4 years by the average capital invested, 667. All right, so my number is correct. Over this timeline, which yields a return of 28.91, because this number exceeds the cost of capital of 25.42 that we calculated in example 3.2 for this project. The return on capital would suggest that this is a good project. In worksheet 3.2, we compute operating income, book value of capital, and return on capital for Granite Quick Charge. The operating income numbers were from worksheet 3.1. So here's our after-tax operating income. We have pre-project capital contributions. We have fixed assets. We have working capital, total capital, book value of capital, return on capital A, and then return on capital B. And I'll explain both. Average book value of capital equals capital P of 1 plus capital divided by 2. Return on capital A, after-tax operating income, average book value of capital. Return on capital B, after-tax operating income, book value capital at end of prior year. So there's two different ways to compute this. I didn't do either. Whoops. Okay, not a big deal. We'll just use these hard-coded numbers. The book value of capital includes the capital contribution in fixed assets, CapEx, net of depreciation, the capital contribution in working capital that year. It also includes the capitalized pre-project funding, and the return on capital each year is computed based on the average book value of capital invested during the year. The average after-tax return on capital computed using the average capital invested over the 10-year period is 4.05. It is slightly lower if we use capital at the end of the prior year. Here, the return on capital is lower than the cost of capital that we calculated in example 3.2 to be 6.35. And this suggests that Granite Construction should not make this investment. Brad Williams, Frugal Finance. Thanks for watching.